Thank you very much. And Yannick, Daniel, Christophe, welcome to Phil's Europe for this year.
Thank you.
Thank you.
Yannick, can I start with you? What would you say has been the standout theme for you this year? And I'd like to ask that of Christophe and Daniel again afterwards. But Yannick, start.
Yeah, sure. I mean, the two themes that I think have been overarching for 2020 are about the unknown and the resulting agility that we had for which we had to adapt. I mean, we're walking into 2020. We had no idea, obviously, the crisis would strike with such an intensity at that time. We had to adapt. We had to trash our history of BCP preparation and so on, and started to work remotely at the beginning of March, obviously. And doing that in a year of unprecedented volumes and uncharted territories. I mean, we've seen increasing volumes for years in fixed income, obviously. Well, 2020 pushed it a step further, and March 2020 for us was 40% higher in volumes than the second largest one. So it's really it was really huge in terms of flows, and we had to adapt all the way to do that in a very challenging environment and remote working environment that we went through.
Thank you very much. Daniel, themes for you?
For me, it was very, very similar. I mean, obviously for us, we were tested really by the nature of the flows, the nature of the liquidity. So it was really the moment where we got to see if our ship could weather a storm. And for this, it was challenging in all directions. Yannick is right. We've been challenged on the operational aspect, but we've been challenged on liquidity. We've been challenged as well on what we thought was a simple separation between low touch and high touch. It turned out that what was low touch became high touch. So huge challenge, very, very interesting. And the second aspect, the second theme was, the link with the data. How do we use our data in the best way to address this? What should be our model in the future? So there you go. These are the two teams.
Thank you, Daniel. That's really good. And Christophe, what have been the big themes for you?
Well, I mean, if you set aside the impact of the pandemic, I think it feels like, in my view, more resiliency was built in the ecosystem as a whole since 2008. And I think that this time around, I mean, central banks acted very quickly, but I think that the mechanics were really in place to handle, enhance market activity, basically. And I think that if you look at the way some of the alternative pools of liquidity were actually able to provide more opportunities, I think for me that's something that played very well into the pandemic impact this year. And that's for me is the major thing, quite simply because of our role as a major infrastructures. We had to move 10,000 users onto the platform as, working remotely from home in a matter of days. That's something we have been never able to do probably a few years ago. This time around, it was done in a matter of days. So I think the market structures did extremely well during the pandemic.
That's great. Thank you very much. And then Daniel, you mentioned the use of data there. How has access to pricing data held up this year? And what do you think traders can learn from their experience?
So I think that, the first lesson is the one I mentioned earlier, is that things are not stable. The division we made between light touch and low touch, easy to trade and hard to touch, has changed. So I think this is the first lesson, is to remember that, not everything is stable and the rule changes. And obviously on this basis, the need for data is crucial. And for me, what it meant is you have to be able to do two things in the same time. You have to be able to look to the past, but you have as well to have a very efficient and a very quick view of what is the situation now and adapt. So it's not only about, pulling past data, but interpreting fast the current data that we need to address. And to me, this is exactly this this challenge that we faced when we found out that, you know, we couldn't play by the same rule. The liquidity was absolutely not the same.
Thank you. Yannick, have you had any other experiences to share on that point?
Well, first, I must thank the other two gentlemen on the panel, because the reason why the AXA system and access to data held up during the crisis is thanks to what they had built way before I joined AXA. So thank you. But yeah, I think the way access to we have tons of data available, of course, and the quality of data varied significantly during the crisis. We had some sources deteriorating massively, some holding up together. So we need to build multiple sources and as Daniel said, interpret very quickly these sources. What I must say helped the best were the proprietary sources of data, the bilateral streams that were built over the years and that fed our trading systems. So we are keeping the emphasis on building that and developing this the interpretation of this data further.
That's very good. And Christophe, as a provider of data to trading firms, were there any lessons you learned in terms of products that work best, use of data that might have changed this year?
Yeah, no, listen, you know, it was back to basics, really. I mean, what we realized very quickly is a lot of people wanted information at the time. Mm-hmm. And not only the trading side, not only the people active in the market, but were, you know, I would say alternative, I would say users or even people outside of the market, more like central banks, were coming to us and asking, even regulators, asking us, you know, can you help us? You know, what's happening? Where's the market going? And what we found is that some of our products were clearly becoming critical in terms of them understanding how quickly the market was moving. And, you know, like an example that we always give is the speed at which some market moved versus 2008. So high yield market took several months to widen to the max. 12 years ago, this time around, matter of weeks. And if you look at the widening of the spreads on US high grade, that 7-fold increase happened in a few weeks. So there was a lot of need for data that was accurate and reliable, but it brings something else to light, which is that, you know, the average spend for investors in terms of the technology that includes the data is really going up. And I think a recent survey showed an average of about $1.25 million of annual spend when you manage more than $1 billion. And that's the case for a lot of asset managers. So we see how important it is to build better technology, but what feeds that technology is the data. And I think the data is really your next trade. And that's really at the heart of everything we do now.
That's very good. Christophe, I want to stay with you for the next question, because I'm interested in how electronic trading protocols held up during this. So let's get your perspective first of all, and then go to the gentleman who actually uses those protocols. What was the market access experience of the different protocols you offer?
Yeah, sure. I mean, our business is really to offer an RFQ solution to our users. And, you know, what we saw and what we've been really building over the years is alternative pools of liquidity, which is the all-to-all trading protocol, what we call open trading. Yep. And what we see and what we can look back on is the Q2 numbers, the public numbers, the Q2 2020 volumes. And we know that today, I mean, our all-to-all volumes have grown to about 32% of the total volume traded on the platform. And that's from 25% a year ago. So we've seen a massive increase in liquidity being provided through the all-to-all. And I think that what we see as well is that investors are, you know, comfortable now providing liquidity. But what we also saw is that dealers are also really comfortable taking liquidity. And I think that's a really reversal of the shift that's happened, you know, a few years back. And the market dislocation in March really accelerated the trend. So we've seen a huge increase in this protocol. And also, I think what has been really apparent is the way trading automation has also continued to grow. And I think the two are kind of linked, because there is a huge, I would say, dependency, again, on how well your technology actually works and feeds you with information that allows you to make a good trading decision. So, I mean, for us, clearly, it's the acceleration and the growth of all-to-all trading, which is a third of our volumes as we speak. So, a big difference.
Sure. And Daniel, as a user, how do you think electronic trading protocols have performed this year?
So, you know, my view is not dissimilar from the view of Christophe, because, you know, if you take the way he separates the market with, you know, the all-to-all pool and what he calls the RFQ, you know, what we've seen is that, you know, the RFQ, which is what was typically called generally electronic trading, was not in itself a pool of liquidity. It reflected simply the underlying liquidity that the bank were providing behind that. So as soon as the bank retreated, then this electronic trading, the liquidity reduced. Again, not the fault of the electronic trading system, simply because the bank were committing less liquidity. So, you know, it did come back ultimately to negotiation, relationship management. You know, when you wanted to negotiate large size through the crisis, you had to be ready in terms of, you know, the usual relationship management and broker engagement to get through. And it worked okay. But again, it was just a sign of the liquidity that was coming out and the need really to engage with the brokers on those risks.
Very good. Yannick, your view, and were there any other protocols that you thought were interesting?
No, I think what has been said. I mean, we always saw electronic trading as primarily a way to communicate. I mean, the same way you don't book a train ticket by calling the station anymore. You can use electronic trading electronic trading protocols to exchange information in an efficient STP way. So we've not been disappointed by electronic trading as a channel. But always said that the market structure indeed had not evolved that much behind the pipes in the RFQs that were built electronically. Indeed, all-to-all trading can be helpful marginally, and we've been using a bit of that. But primarily, we've seen that, as Daniel mentioned earlier, some low touch, what was low touch before actually came back to a higher touch, even though confirmed electronically during the crisis.
That's great. Now, you mentioned communication there. Obviously, remote working became a massive, well, it seems to be a hurdle for people to overcome, but it worked very well. How was communication between traders and portfolio managed in the workflow during the process of becoming a remote office and since then? Yannick?
Yeah, obviously we had to change completely the way we communicate by not sitting together and being the same office. But the feedback we got actually a few weeks into the crisis that there was actually more communication between the traders and our clients, the portfolio managers, than there was before the crisis. And we found ways to make the communication richer as well by using this data that we discussed before, input from market data, input from data science added on top of the raw data that were received, and so on. So we had to be more structured, more focused, more targeted in terms of the way the information was directed in order to be more meaningful.
That's great. And Daniel, did you think there was a formalization of communication processes in this period?
So the answer is yes, and I think, you know, what we found out is that many of the tasks we took for granted because we were sitting together needed to be formalized, and if we formalize them, we would be able to be more efficient into deploying our clients' cash. So, you know, the way we engage with the portfolio manager changed, and I think that was for the better, and it helped a lot. And if you allow me one comment, just beyond this, the point of between trader and PM, I mean, what we found is we were very careful between trader and PM to maintain communication, and it worked. Where we were challenged is where we did not expect, because we had much more issue on the settlement change, on the settlements, that somehow we had as well to engage into communication we thought was smoother, was already very smooth with the banks, just to make sure that this would work. So it was very surprising ultimately that the challenge did not come where we expect.
Absolutely. Were there any other changes in the communications you had with counterparties, Daniel?
I think yes. I mean, look, we are moving beyond the physical presence and the way we exchange data, the way we want to look at the process that are quite heavy is now changing. So what we are doing now is that we are really reviewing all the heavy communication process, all the manual process. You can discuss primary, you can discuss portfolio trading. Everything that takes time now is being looked at so that we do it in the most efficient way.
Thank you. Yannick, are you using any different tools, or are you communicating with counterparties in any different ways?
No, I think to summarize what happened during the crisis in the bilateral communication is what was automated or STP worked well. Everything else took longer to channel. As a result, every process that had some kind of manual intervention in it was actually longer and was more difficult to implement. Hence the collateral management issues and all the post-trade issues that materialized and that Daniel mentioned. So yes, of course, we are seeing how we can make these bilateral communications as streamlined as possible and as APIs as possible to make it more efficient. And on the other hand, we keep a very important relationship, or we put a very big emphasis, as we said before, on the bilateral relationship, because that's where the liquidity comes from when the crisis hit.
Absolutely. We have seen that electronic liquidity providers or non-traditional dealers have come into the market increasingly as counterparts this year. Christophe, just from your perspective, how do you see non-traditional liquidity providers moving into the market with you as an intermediary?
Sure. Well, that's been the case for, I guess, for many years. But again, it's the service that we provide fits very well with the way some of those alternative providers of liquidity actually operate today. So I think the ability, again, to use technology to quote and to actually auto quote prices is extremely important. Mm-hmm. And we know that, for example, auto execution today represents about 11% of total trade counts on the platform. And we had more than 3.5 million algo responses in the second quarter, just for the US high grade and high yield market. So that segment is really growing, and that's growing because some different providers of liquidity are able to use technology and really connect over thousands of different line items. But what we also see is that's really also driving others, more traditional market makers, to step in line and start to really accelerate the change and invest more, again, into the same technologies. So I think that in a way, the non-traditional providers have really been creating a bit of a trend. And now we see that the whole market is really moving into that space where maybe with a focus on cost and performance, people are maybe also looking at being more efficient when it comes to trading. And as I said earlier, what we see today is that more and more dealers and banks are trying to take liquidity. So I think for me the rules are kind of changing. Yep. And there's, I think, a different role that people are playing today. And when we talk about traditional liquidity or non-liquidity providers, it's also now including the investors. And I think that's also the last part of my answer, is going from really the banks to non-banks to now investors providing liquidity. And investors are not only traditional investors, they can also be central bank or sovereign wealth funds and so on. So it is really that shift that we really see, I guess, from our seat, really happening really globally. And that's very much the case in Europe and also the case in Asia, as we know.
Thank you. And Daniel, has your view of non-traditional dealers changed, the electronic liquidity providers, etc.? Have you engaged with them more this year?
So I would say a bit, not much. You know, you always had this view even before the non-traditional providers, where you were categorizing the broker you engage with as whether those guys were market maker or prop traders. And somehow, you know, the prop trader had their advantage. You know, you could not count on them, but sometimes they would give you amazing prices.
Yes.
So you've always had that categorization. Now with technology, you know, this is evolving. You have, you know, as Christophe mentioned, yes, you have something interesting, which are different marketplace where somehow you can intelligently provide some form of crossing, not precise crossing, but manage interest of the place, you know, between clients. And yes, you still have now those prop traders, and you know, and because these are really prop trader companies, you know that you know what they are. So I've still had a kind of a negative view on this because, you know, as we've seen on a large illiquid credit trade, your capacity to engage constructively so that you make sure the counterparty is with you through time, so the counterparty knows that you're not going to disrupt the market, but in that case, it will have access to large flows. So the relationship you build has been important for you know, for managing through the crisis. So yes, there is probably a room for those prop traders, but we need to be careful. And I have to say, on my side, you know, when I see the news on the equity side of what's going on with the retail broker that somehow sell their client flows, it does make me actually kind of wary. And I think it's something we need to continue paying attention to.
Very good. Yannick, has your relationship changed with electronic liquidity providers?
Yes and no. I mean, it's a fact that alternative liquidity providers take a growing market share. So I would not deny that. However, the view we have indeed on them is that they can be efficient in for very small clips in benign market environment, but disappear completely as soon as a crisis strikes, and or when you need an actual risk transfer, where you need a balance sheet in front of you, and only market makers with decent balance sheet can do that. So we have not seen the market structure evolve that much from that perspective. The technology has evolved, the market share is growing. There are smaller clips out there, but the real actual liquidity always comes from the same place.
That's great. Thanks very much. And then finally, I was just wanted to ask the sort of impact of central bank policy at the moment. If we see continuing low interest rates, do you think that we might see an increase in the use of repo and derivatives in portfolios to enhance returns? And might that affect trading operations? Yannick, your view?
Yeah, I think I'll go very quickly because I think we're approaching the end, but yeah, we need to take into account the various options available when we want to implement the strategy, and indeed derivatives and leverage repo are tools that we use to actually take the position that we ultimately want to take. So our job as traders is to assess the opportunity and cost and liquidity risk associated with each of the options. But yeah, we expect to keep using them.
That's great. Daniel, your perspective?
Same, you know, zero interest rate, people will need to do several things in the same time in order to get the return they expect, which means using off balance sheet and derivative to implement their multiple strategy and enhance their returns. So yes.
Excellent. Christophe, you, as a market operator, are you planning for increased use of other instruments and trading strategies? Oops, Christoph, I think you're on mute. Sorry. There we go.
Sorry, yeah, I had a very busy truck outside my windows. No, I think that we when you look at the fact that close to 95%, I think, of assets under management just are buy and hold and don't move. You have to try and come up with some pretty good ideas to make that performance, that extra performance. So yep. I think there are some opportunities out there. I'm just not sure about the risk appetite right now. And I think that we go into a fourth quarter with many banks having had a pretty solid second and maybe third quarter. We'll see soon. So given the geopolitical events to come, I think that the hunt for yield and maybe the appetite for risk could be quite dampened by the potential events. So, but as a market structure firm, we try and build the right solutions for our clients. And maybe one little piece of anecdote that I think is interesting to know is that we see, most people see all to all as something that may take care of the small bits, but we've traded 149 million this year, for example, as a clip in a pretty long duration bond. So I think that there is a space now for new ideas and new protocols in the market.
That's great. Thank you very much, all of you. I think now we're going to open up to questions from the audience.